By mid-2025, record valuations across the crypto asset market were being underpinned by a $300 billion sector known as stablecoins. Stablecoin issuers market their tokens as digital volatility hedges. The core promise is simple. Every digital token is pegged one-to-one with a traditional fiat currency, usually the US dollar, to ensure price stability even during a broader market crash. Because of that steady value, they serve as the primary on- and off-ramp for the digital ecosystem. If you want to trade crypto, you use a stablecoin to move your cash onto the blockchain. They function as a direct structural bridge, linking the decentralized web with the traditional banking system. When a standard cryptocurrency crashes, the losses are mostly contained to the investors holding that token. Stablecoins, however, hold billions of actual dollars in reserve accounts at real banks. By weaving the highly speculative crypto ecosystem directly into the plumbing of the traditional financial sector, an isolated digital panic now has the established pathways required to threaten the broader global economy. To understand that threat, look at how a currency peg is maintained. When you buy a stablecoin, the issuer takes that physical cash and parks it in traditional assets, typically a mix of standard bank deposits and short-term US Treasury bonds. The danger arises when users lose faith in those reserves, an event called depegging, where the token drops below its promised $1 value. We saw a live stress test of this in March 2023, when tech investors lined up outside Silicon Valley Bank in a panic. SVB held over $3 billion in cash reserves for USDC, one of the world's largest stablecoins. As SVB collapsed, crypto users holding USDC panicked and rushed to cash out their tokens. To honor those redemptions, the stablecoin issuer had to immediately attempt massive, sudden cash withdrawals from its traditional banking partners. This chart shows the immediate shock to the market. Notice the sharp percentage spikes for both USDC and DAI, occurring exactly at the moment of the SVB failure line. Because stablecoin issuers concentrate billions of deposits across a few small banks, a sudden wave of digital redemptions instantly drains a real-world credit institution of its liquidity. Looking closely at the data from the weeks following the failure, the localized banking stress cascaded into a broad panic. This chart shows the market capitalization for USDC dropping sharply and failing to recover as users abandon the token entirely. In a digital environment, a bank run doesn't happen at the speed of people waiting in line. It happens in seconds. Any traditional bank holding these massive stablecoin reserves is uniquely vulnerable to that hyperspeed collapse. Now, take that regional banking risk and scale it up to the size of the largest global players. A single systemically critical token, like Tether, holds over $150 billion in reserve assets. If a panic of that magnitude were to strike, bank deposits wouldn't be enough. To cover the withdrawals, the issuer would be forced into a desperate liquidation of its primary backing asset, US Treasuries. Suddenly dumping hundreds of billions of dollars of Treasuries onto the open market creates a massive supply glut. That overwhelming volume crushes bond prices. When bond prices fall, the yields, the interest rates paid on that debt, spike artificially. A run on a mega token sends a severe shockwave across global sovereign debt markets, driving up borrowing costs for businesses, consumers, and the global economy. While advanced economies worry about their bond markets, emerging and developing economies face an entirely different kind of contagion vector. In regions with limited regulatory oversight, citizens frequently adopt global stablecoins pegged to foreign currencies to protect their savings. This mass adoption disrupts local capital flows, draining wealth out of emerging markets and funneling it directly into a central US dollar hub. As more people abandon their local fiat currencies for digital US dollars, the demand for the domestic money drops. This triggers severe currency devaluation and deepens local fiscal instability. This cycle of capital flight and local devaluation effectively exports financial instability to developing nations, undermining their ability to maintain monetary sovereignty. Crypto promoters often pitch these tokens as a frictionless, revolutionary evolution of money, but beneath the blockchain branding, stablecoins operate exactly like the shadow banking instruments and money market funds that triggered previous traditional financial crises. They suffer from a deeply embedded structural flaw known as a maturity and liquidity mismatch. You have an instantly redeemable digital token on one side, heavily unbalanced against a slow-moving 30-day traditional treasury bill on the other. It is mathematically impossible to guarantee that millions of users can cash out their digital tokens simultaneously, when the real-world debt backing those promises takes time to sell on the open market. During the 19th century free banking era, private banks issued paper currencies with little federal oversight, leading to devastating bank runs. The crypto industry has simply transposed that exact vulnerability onto the blockchain. Regulators are reacting to the scale of the threat. The European Union recently introduced the Markets in Crypto Assets Regulation, or MiCAR, a framework designed to enforce strict reserve and transparency requirements on issuers operating within its borders. Yet, the vast majority of stablecoin trading volume relies on massive, non-compliant tokens issued by third-country entities operating offshore. This leaves a severe regulatory blind spot hovering over the global market. In the United States, policymakers actively encourage the proliferation of these dollar-pegged tokens. Promoting stablecoins globally creates a massive, captive source of demand for U.S. Treasuries, artificially reinforcing the dollar's dominance. Stablecoins have grown too large and too connected to be treated as an isolated crypto experiment. Without a globally coordinated framework to enforce compliance and audit these offshore reserves, the next digital panic will drag the traditional economy down with it.